Welcome. I'm Ernie Goss, research faculty member with the Craig School of Business here at Fresno State University in beautiful Fresno, California. Today, I'm going to talk to you about our survey results for businesses in the four-county metropolitan area for the month of July. And what is that telling us? The leading economic indicator from that survey for the San Joaquin Valley, the Central Valley, again for the month of July, what it's telling us what happened in July, but what's likely to happen later on in the San Joaquin Valley, the economy of the Fresno metropolitan area. First off, the overall index, which again is a leading economic indicator, and it stretches from 0 to 100, and 50 is growth neutral. Anything obviously above 50 is growth positive, below 50, not so good, growth negative. So, the index was above growth neutral for the 8th straight time. This economy, this Fresno economy, this San Joaquin Valley economy, this Central Valley economy is expanding, doing real well, back to pre-recession levels for most areas of the economy. We're seeing that move ahead. The overall index, which again is the leading economic indicator, went from 57 to 57.3. Now, for those of you who are gauging that by your old biology high school class, that doesn't sound very good. Don't judge it that way. Again, anything above 50 is growth positive. 57, I think, I use a gauge of anything above 55. I'm saying that's pretty strong, pretty good. So that's looking at good ahead. The job index went from 57.8 to 58.1. Again, expanding. Things are looking better. Now, it's sort of an incremental. We're inching up in this economy, and that's not such a bad thing. Do you want to see this volatility? The answer is no. Because for every down, you've got some ups. So this inching up is a good thing. Our inflation gauge for the San Joaquin Valley rose from 69.8 to 70.2. Now that's getting a bit stronger. That's elevated inflationary pressures. Of course, a lot of that's food, a lot of that's energy. You put that in there, and we economists sometimes say, well, if you take out food and energy, and the question is, why would you? That's what you're paying for. And that's what a lot of folks are complaining about. That's what we're seeing in our survey. The business confidence index went from 58.8 to 61.3. Now that's somewhat unusual in my judgment given all the international tensions that we're seeing, but businesses are more confident than they were for the month of July, so that's a good thing. Inventories came down. They went from 53.9 to 47.5. Now that's a little odd, but we had, as you know, many of you, if you follow the economic indicators, inventories had been building up. They're now coming down a bit. That's not such a bad thing. The economic, now what I will say is not so good for the San Joaquin Valley economy is exports. Export number went from 48.2 to 43.5. We need to see more exports. That would certainly be good for the economy. Imports went from 48.2 to 49.3. Again, not so good. Then trade, those numbers are both below growth neutral, so not so good for the month. Now we asked the businesses, what is the biggest driver of your business over the last year? What's been the real kick in the hiney over the last year? Has it been interest rates? Has it been the Affordable Care Act? What has been pushed to either negative or positive? About one-fifth, about 22.2%. A little over a fifth, said the farm economy. Now that may sound like strange to many of you out there, but the San Joaquin Valley, it depends heavily on farm income and what goes on in the farm economy. Now, when we asked the businesses how much they thought prices for their product would grow over the next year, 2.4%. Now that's on the weak side, even though I just said our inflation gauge is up, but that's the inflation gauge for products they buy, not the products they sell. The products they sell, 2.4%. The products they buy, more than that. So you're going to see a little of a pinch in terms of income, meaning your sale price is not growing as fast as the prices of products you buy. Not such a good thing. Now for the area, when we look at the indicators from not from our survey, but from other government data, the unemployment rate down from 12.6% to 10.5% over the last year. Obviously good. Number of unemployed down by 10,000 over the last year. Again, good signals for this economy, and it's moving forward. Now, when we ask, unfortunately, earnings aren't growing. Now, again, you don't need an economist to tell you that. Average weekly earnings almost flat from this time last year. Not good. Now, what are the areas that are growing? Construction. Construction continues to move ahead. It's not back to pre-recession levels in terms of jobs just yet. It's moving in that direction. Got a ways to go there. Manufacturing, flat in terms of jobs. A lot of productivity growth there, meaning getting more work out of your current employees, not as much output there. Food processing, the manufacturing side. Now there we are seeing some better numbers in food processing, which is very important. Wholesale trade, likewise. Professional technical services doing very well in the area. So one of the other, I won't say troubling areas, but temporary employment. We are seeing companies hiring using temp services. That'll eventually, they'll translate or convert those into full-time permanent jobs, and I certainly want to see that in the weeks and months ahead, because this has been Christmas in the summers. I mean, by that I mean all the data has come out this week that you've seen, our surveys, the GDP report that came out this week, the Federal Reserve, their pronouncements. All that is overwhelming to some degree, and all of it's telling you about the same thing, that growth is continuing ahead, just not quite as strong as we'd like to see. But then we economists have been telling you that. We've been telling you that for a couple of years now. We haven't changed our tune yet. Now, what should you watch for going forward? What are the economic indicators? On August the 13th, watch out for the retail sales number. That's pretty important, telling you where the consumer's going. We need to see growth better than what it's been. It's been about 4%, and that includes inflation. That's annualized. Need to see a number stronger than that. Need to see 5 to 6%. Look at the July CPI, which comes out on August the 19th. Very important. Now, why is it important? It tells us what the Fed's going to do. The Fed is thinking about, considering, ruminating over raising interest rates, and they're going to do it, of course. When is the question. Now, if that CPI is growing by more, between 3 and 4%, that's annualized, you're going to see a movement on the Fed to raise interest rates maybe as early as the first quarter of 2015. That's my bet right here. And you can rewind this back a couple of months from now and see that I did say it first quarter of 2015. That's a little ahead of most other economists, meaning most economists are saying mid-year. I'm saying first quarter. Another big issue watch out for is Argentina. Can you imagine that? They're discussing, saying they may default on their bonds. Now you think, well, that'd be really bad for the U.S. It'd be bad for some people in the U.S., investors, but think of this. What it will do is reduce our interest rates. Now, why does that happen? Because everybody gets out of these riskier bonds. They buy our bonds, and that reduces our interest rates. In other words, investors more willing to lend to us. Now, what are the risks going forward? Another factor you need to watch out for is trade embargoes. As all of you know, Russia took over Crimea. Now they're bombing, along with their allies in Ukraine, eastern Ukraine, bombing the rest of Ukraine. What are the dangers there? Well, what we've done thus far is we've restricted trade sanctions on Russia, and that's fine. But the retaliation we'll see, and I'm not arguing should or shouldn't do. That's in politics, but economically speaking, trade embargoes, trade sanctions slow the economy down. If we see those expand or explode, if I can use that term, sorry for the pun, no pun intended, that's a real danger. So that's it, folks. That's the month of July here at the Craig School of Business. I'm Ernie Goss with Fresno State here in beautiful Fresno, California. Thanks for joining in. Until our next survey, which comes out on September the 2nd, may your economic cup runneth over, and thank you.